Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of corporate filings, and boy do we have a juicy one for you today. It looks like our friends over at FundVantage Trust, the entity behind the Polen ETFs, are giving us a peek behind the curtain with their latest N-CSR filing. Get ready for some serious financial deep dives and maybe even a peek at some behind the scenes accounting maneuvers. Before we dive in, if you appreciate getting straight insights from these dense SEC documents, make sure you hit that subscribe button. And if you want to connect with us and other corporate finance enthusiasts, join our Discord community linked in the description below. So what exactly is this filing all about? It is essentially a shareholder report from FundVantage Trust, which manages several different ETFs, like the Polen Floating Rate Income ETF, the Polen High Income ETF, and the Polen Focus Growth ETF. This report covers the period ending the 31st of October 2025, giving us a snapshot of their financial health and performance during that time. It's like reading a company's diary, but with more numbers and way less drama, mostly. Let's start with the Polen Floating Rate Income ETF. For the 6 months ending the 31st of October 2025, this fund saw its net assets grow to over $10 million, which is a positive sign. That is a decent chunk of change. But what does that actually mean for investors? Well, the report tells us they had 111 holdings in their portfolio, and get this. The total advisory fee paid was just over $23,000. That might sound like a lot, but compared to the total net assets, it's a pretty small slice of the pie. Now, let's talk about where the money is actually invested. This table gives us a breakdown by sector, and it looks like industrials made up the biggest chunk at 21.8%, followed by consumer non-cyclical at 20.5%. What's interesting here is the negative percentage for liabilities in excess of other assets at negative 15.1%. Don't let that scare you too much. In simple terms, it just means their liabilities were a bit higher than their other assets at that specific moment. It is not necessarily a red flag, but it is something to keep an eye on. Moving on to the Polen High Income ETF, this one is a bit larger, with net assets around $21.3 million. They had 131 holdings, and the advisory fees here were about $49,000. Again, looking at the percentage of assets, it is a reasonable cost. The sector allocation here is a bit different. Consumer non-cyclical leads at 22.6% and then consumer cyclical at 17.2%. This ETF also has a small positive for other assets in excess of liabilities at 0.5%, which is a good sign. Then we have the Polen Focus Growth ETF. This one is the biggest of the bunch with over $112 million in net assets. Keep in mind, this fund is pretty new, having started operations on the 30th of September 2025. So its performance data is for a very short period. Its portfolio is heavily concentrated in information technology at 38.5%, and then healthcare at 15.5%. Interestingly, it has 0% for other assets in excess of liabilities, which is ideal. Now, for the really juicy part, the actual investments. Let's dive into the Polen Floating Rate Income ETF's portfolio. This is where we see specific companies and the types of debt they hold. We've got senior loans in consumer discretionary products like Auto Kiniten US Holdings, Inc., and Hunter Douglas Holding BV. Then there are senior loans in healthcare, which include companies like Aviana Healthcare and Bausch & Lomb Corp. The percentages here tell us how much of the fund's assets are tied up in each type of loan or bond. For instance, senior loans make up a massive 87.1% of this fund, which is a very high concentration. This means the fund's performance is heavily tied to the overall health of the senior loan market. They also hold corporate bonds like those from Dornoch Debt Merger Sub Inc. and Real Hero Merger Sub 2 Inc. These are essentially loans made to corporations, and like senior loans, they carry risk if the company can't pay them back. The total corporate bonds held by this fund are about 14.4% of its assets. Looking at the statement of assets and liabilities in simple terms, it is a balance sheet for each fund. For the Polen Floating Rate Income ETF, total assets were about $12.5 million and total liabilities were around $2.4 million, leaving net assets of just over $10 million. This means the fund is financially stable at that point in time. You can see the breakdown of investments, cash, and receivables balanced against payables and other liabilities. The statement of operations is where we see how the funds made or lost money. For the Polen Floating Rate Income ETF, they had investment income of over $500,000, mostly from interest. But they also had some net realized and unrealized losses from investments, totaling over $223,000. This means the value of their investments went down during the period. The net result was an increase in net assets from operations of about $279,000. Now, let's look at the 6-month period for the Polen Floating Rate Income ETF. The The total investment return was 3.25%. That is not bad, but it's important to remember this is a snapshot for a specific period. The ratio of expenses to average net assets was just under 0.5%, which is quite low, meaning they are managing costs effectively. For the Polen High Income ETF, its total investment return for the 6 months was 4.73%, which is stronger than the Floating Rate Income ETF. This fund is heavily invested in corporate bonds, making up 85.6% of its assets. We see companies like Adient Global Holdings and Armour Sports Company listed here. This higher concentration in corporate bonds, especially those that are not investment grade, generally means higher potential returns, but also higher risk. Their expense ratio also remains quite low at 0.53%. The Polen Focus Growth ETF, being new, has a very different investment strategy. Its focus is on common stocks with a whopping 38.5% in information technology companies. You see big names here like MasterCard, Visa, Alphabet, and Microsoft. The total investment return for this fund for its short period was 2.24%, given its heavy tech focus. It experienced a significant net change in unrealized depreciation, losing over $11 million. This highlights the volatility associated with growth-oriented tech stocks. They can shoot up fast, but they can also fall just as quickly. An interesting development in this filing is the change in their independent registered public accounting firm. PricewaterhouseCoopers LLP WC was dismissed and Cohen & Company Limited has been appointed. This often happens for various reasons, and the report states there were no disagreements with PwC, which is good. It indicates a smooth transition rather than a sign of financial trouble or accounting disputes. This section delves into the board's decision to approve the investment advisory agreement for the Polen Focus Growth ETF. They considered the services provided by Polen Capital Management, the firm's qualifications, its financial stability, and importantly, the fees. They noted that the proposed strategy was new and didn't have historical performance, but they looked at the performance of other series managed by Polen Capital as a proxy. They concluded that the advisory fee was within a normal range for similar ETFs, and that the arrangement was fair for shareholders, especially considering a unified fee structure that covers most expenses. This is a standard process, but it is good to see the board doing its due diligence in approving these key contracts. Scroll no, let's talk about the real story here, the financials. It is always about the numbers, right? For the Polen Floating Rate Income ETF. We see that while they had investment income, they also had net realized and unrealized losses from investments. This means the value of what they held actually decreased during this period. For the Polen High Income ETF, the picture is a bit more positive with a better total investment return, which is likely due to its heavy investment in corporate bonds that may have performed well or provided good interest income. The Polen Focus Growth ETF shows a significant unrealized loss, which is common for newer growth focus funds, especially those heavily invested in tech stocks, which saw some volatility recently. It is a case of high reward, high risk. Looking at these filings, FundVantage Trust and its associated Polen ETFs seem to be operating in a fairly standard manner for the industry. The expense ratios are generally low, which is a big plus for investors. The change in accounting firms is noted, but without any reported disagreements. It appears to be a routine shuffle. The focus on their investment strategies, especially the new Polen Focus Growth ETF, shows a clear plan, though the inherent volatility of tech stocks means investors should be prepared for ups and downs. The significant investment in senior loans for the Floating Rate Income ETF also points to a specific risk tolerance, as these can be less liquid and more sensitive to economic downturns. The company's direction seems to be in growth and careful management of their expense structures, evident in the low expense ratios and the board's scrutiny of advisory fees. The risks are primarily market related, as seen in the unrealized losses in the Focus Growth ETF and the general risks associated with senior loans and corporate bonds in the other two. Opportunities lie in potentially strong returns from their chosen investment strategies, provided markets remain favorable and their risk management is effective. In conclusion, these reports paint a picture of well-managed, albeit distinct, investment vehicles for the investor. The key takeaway is to understand the specific strategy and associated risks of each ETF. Are you looking for stability with floating rate income, higher potential returns with corporate bonds, or aggressive growth with tech stocks? These reports give you the data to make informed decisions. Alright, that is our deep dive into FundVantage Trust's latest filing. What are your thoughts on these ETFs and their strategies? Do you see any red flags or hidden gems? Let me know your take in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more straightforward breakdowns of complex corporate information. And don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.